It is our famous Fearless Forecast program today, so you don't want to miss that. That's for sure. It's the tongue-in-cheek exercise that started over 3 decades ago by my father-in-law, Jack Nelson, when it was just him on the program, joined together for about a dozen years in there, maybe a little bit longer, and then for the past several years, it's just been me sitting here doing the Fearless Forecast as we like to do on the last Sunday of the year. So we're going to talk a lot about that. Plus, of course, we need to update you on the Secure Act. It passed, which means that it is the most sweeping changes to your retirement this decade. Probably this, not just this past decade, but maybe even the past couple of decades. So much to talk about on the program. We hope that your holiday week was a good one. We got another holiday coming up on Wednesday, of course, New Year's. So a couple of weeks where it's been a little odd with the holidays falling on the middle of the week. Not a lot going on before the holiday, a lot going on after the holiday, so a couple of quiet weeks, if you will, and so that's always good, right? If you've got some quiet weeks, perhaps that's an opportunity to rest, to relax, and enjoy family. I know we're certainly doing that at my house with my oldest home from college, so we're enjoying that, and thankfully, his team, or his college team, the Auburn Tigers, is playing in Florida. So that's pretty cool. Not only is it playing in Florida, but it's like playing like an hour and a half down the street from Orlando over in Tampa for the Outback Bowl. So on Wednesday, we get to do that. And so that should be a lot of fun for a change. I've never been to a bowl game where there is a very vested interest by one of my kids. So this will be fun. And fortunately, the calendar and the bowl season schedule worked out for us to do that. So today is, of course, our Fearless Forecast, and we'll get into that. But before we get to our Fearless Forecast for the year 2020, it is incumbent upon us to recap what our Fearless Forecast was for 2019, right? If we're going to have a Fearless Forecast, it's always good to say, well, wait a minute, how did we do this past year? And we're doing it on today because this is the last Sunday in 2019. Next Sunday, we will certainly sort of true up the numbers, if you will, because there's still a couple of trading days left, Monday and Tuesday. There's still a couple of trading days left in 2019, so we don't know exactly how things are going to play out for the year. But so far, it's been a pretty good year. The Dow Jones Industrial Average is up over 22% for the year. And so, but by the next time we meet again on our Sunday program, then on Sunday, next Sunday, it'll already be January the 5th. And so there'll be a couple of trading days already in the new year. So we always like to do our Fearless Forecast without any knowledge of what actually is happening or has already happened in the year 2020. So we will certainly give you some thoughts as to what we see for the trends ahead next year and how that's going to affect the economy, how that's going to affect the markets, and ultimately how that leads us to the forecast that we're going to make for the year 2020. Now remember, as we said at the top of the program, this is a tongue-in-cheek exercise. If you think we're sitting here under the impression that we can predict the future, the answer is, of course not. Nobody can. This is just a fun exercise that we like to do around this time each and every year. We also like to compare how we did. And this past year was actually one of our more accurate Fearless Forecasts. We were getting almost dead on this one for 2019. For the year 2019, we predicted a Dow that would hit 28,400. Still a couple of days left. Not sure exactly how close or how off we will be on that, but this past week the Dow was hovering around 28.5. We thought 28.4. Hey, not to spend the rest of the program tooting our own horn, but that's not too bad, really, when it comes down to it. It might actually be one of our more accurate forecasts, although we've been pretty close for the last 8 years. Okay, if you go to 2012, I have to look at my little sheet here. 2012, we predicted a Dow at 13.5. It actually closed in at 13.104, and it's within 400 points. That's pretty close. 2014, we predicted 17.6 on the Dow. It came in at 17,823. That's pretty good. That's within a couple hundred points. And then in 2016, we predicted 20,000 on the Dow. Actually, that was a repeat of what we predicted for 2015 because we weren't accurate in 15. But in that year, 2016, the Dow closed at 19,762. So for the last 8 years, we are, we're super close. Well, the other 4 years, well, suffice it to say that we were not accurate. And we'll leave it at that. But that underscores the reason why we don't time the market and we don't sit here and think that we know what the future's going to hold. A 4 out of 8 sounds like kind of a mixed bag when you stop and think about it. And so with that perspective, we always like to have the full disclaimer on it that this is not an exercise in market timing by any stretch of the imagination. So take it for what it is, a fun little exercise that we do each and every year. Now, certainly the year's been very good. And Dow Jones looks like it's going to close about 20% above where it started the year at. And so that's great. Love that. Good year, all that. But some perspective. And here's the thing to remember. A year ago at this time, we were not nearly this holly and jolly and happy because the market had just gone on a 20% decline during the course of about the end of October, beginning of November, through Christmas Eve. And so our contention a year ago, looking ahead into 2019, is that a lot of the year 2019 would in fact be a recovery from that rapid decline that we saw in the fourth quarter of the year 2018. And to give some perspective on it, if you go back to the level mid-September of the year 2018, the Dow Jones Industrial actually sat at 26,743. Okay, so remember that number, 26,743. Today we're hovering around 28.5, thereabouts. And so when you think of that in terms of return, a lot of attention is getting paid on the year 2019. And certainly it's been a good calendar year. We don't take anything away from that. And we thought it would be a very good calendar year because the reality is, though, that sharp decline that we saw in the fourth quarter of last year was very quick, very reactionary. And if you go back to where the markets were in September, so what is that, like 15 months? You'll find that the markets, in fact, the Dow was at 26,743. So if you look at that to where we are today, over the course of the past 15 months, the markets are only up about 7%. So a little perspective always goes a long ways when we talk about the market and market performance. When we get back, we're going to dig into some of the things that we see for the year 2020. Welcome back to the program, ladies and gentlemen, dollars and cents. This is Joel Garris of Nelson Financial Planning. You're listening to News Radio WFLA Orlando. If you're listening to us on Sunday morning between 9 and 10, that's where we're at. If you're listening to us at other times, then that must mean that you subscribe to our podcast, which is on a variety of podcast channels. Just go to our website, nelsonfinancialplanning.com. In the upper right-hand corner, you'll see a bunch of icons. Whichever one looks sort of more familiar with you, click on it and it will direct you over to that channel that we are on that particular platform. Also on YouTube, where we put up the video of the program as well. You get to see me and sitting here in front of a microphone staring at the camera, using my hands a lot because, well, after all, I talk with my hands. But now you get to see that. See, before when we weren't videoing the program, you never got to see that. Anyway, this is our first Fearless forecast that is on a video. Speaking of that, the video was something we started this past year in 2019, but the Fearless forecast is certainly not new. It's an exercise we've been doing for over 3 decades on this program, and it, after all, is very much a tongue-in-cheek exercise. The last segment, we gave you a little bit of a perspective of where we thought the year was going to go, and lo and behold, we actually wound up being somewhat accurate this year, predicting Dow Jones Industrial Average closing out at about 28.4. Don't quite know how it's going to close out because we've still got a couple of days left in the year, but the reality is that the Dow hovering around 28.5, 28.4 is pretty darn close to that. A lot of thought went into that prediction simply because, but it also took into account what was going on at the time. So lest we forget, the market was going through a 20% decline during the months of October, November, December of last year, 2018. And so consequently, we thought that this year would be the recovery year. If you pull back the lens, as we were saying, if you pull back the lens and look at where the markets were in September of 2018 to today, it's not as exciting as the media is portraying the calendar year to be. Certainly the calendar year 2019 has been good. Market Dow Jones Industrial Average up over 20%. But if you go back 15 months, that's only up about 6.5%, 7%. So a little perspective always goes a long ways. Now, as we look to the year 2020, what's in store and what do we think will be some of the important trends to really watch as it relates to your money and the economy? Well, we're going to start with what I always think of as the most powerful economic force in the U.S. economy. And you know what? That's you, that's me, and that's everybody else in this great country of ours. Why? Because the consumer drives about 70% of the U.S. economy. So, as the consumer goes, generally speaking, so too does the U.S. economy and the U.S. markets. The good news there, and there's a lot of good news on the consumer side. First of all, when we look at where they are in terms of the savings rate. The savings rate is on an uptrend. The savings rate for the consumer today is about 8%. That is a significant aberration from what we typically see in late cycle part of the economy. Obviously, the economy has been on a growth cycle for a while. We're clearly at the more to the end than we are to the beginning, obviously. And typically what you see in those later years of the economic cycle, that late cycle economy, is that you wind up seeing people starting to spend more, starting to get ahead of themselves, starting to throw money around a little bit more loosely because they forget about the fact that there can be tougher economic times. That's just basic fundamental human nature. You go through a period of time where things are good, you start to forget that things can be bad, and so you start to get overextended. Interestingly, in this time around, it does not appear that the consumer is going down that path. In fact, if you look at consumer debt relative to GDP, it is the lowest level that we've seen since before this current economic cycle started. That consumer debt to GDP level is the lowest that we've seen since 2003. So some pretty interesting statistics there when you start to peel back the onion. Consumer really in pretty good shape, saving a lot, savings rate much higher, not getting too crazy as the economic cycle continues to move on, not overspending. Certainly when you look at debt relative to GDP, we hear a lot about the absolute number of debt, but folks, when we talk about absolute numbers, it's important to have a baseline to compare them to. When you look at consumer debt relative to GDP, it's the lowest level that we've seen since 2003. So some pretty interesting numbers there when you start to put some comparative analysis on those debt numbers. So the consumer, pretty good. Rising wages, low unemployment, very strong labor market. Consumer, pretty good shape. So that checks a pretty significant box when we're looking ahead to the year 2020 and making our fearless forecast. Number two, not as important as the consumer, but certainly very important. It's those folks at the Federal Reserve. Federal Reserve appears to be on hold in terms of interest rates. Well, guess what? They're holding at a level of interest rates that is very, very low, incredibly low. And so low interest rates always has a tendency to really help continue to push economic growth because the cost of borrowing is obviously low if interest rates are low. Now, as with every year, there are always some storm clouds. So let's talk about them. There could possibly be some pressure on corporate profits. The reality is that a better labor market leads to higher wages. Higher wages eat away at corporate profit margins. So the same thing that's positive for the consumer ultimately starts to eat away a little bit at corporate profits, which are, of course, a big driver of the market as well. What typically happens is as those rising labor costs occur, corporations push those costs onto the consumer. The problem is because inflation has been relatively low, they've not been able to do that. So that has not really happened. So you could potentially see some pressure on corporate profits. Second of all, it's an election year in case you've kind of been living under a rock. There's a big election coming up. And ultimately, what typically occurs there is you wind up having a lot of volatility through the primaries. There's a ton of proposals that are floating around out there. It's really hard to kind of get a feel for what ultimately will be the platform that these candidates run on. But the reality is that certainly that primary and the election season are going to add a level of unknown, a level of uncertainty that might very well, in fact, create some volatility in the market. And then thirdly is always the stuff that we don't know, right? I mean, we don't know the future. So does the trade deal with China, rear its ugly head and they don't ever get past the sort of the initial phase of it? Does the issues with North Korea really start to take forefront again? What about Brexit? Although some of those issues seem to have been getting resolved, certainly Brexit and the China trade deal. So perhaps there's not as much uncertainty on that. Clearly, in an election year, there is obviously a focus on trying to really keep things as calm as possible, particularly with the current administration. I would imagine they want to keep things as calm as possible to help make sure that consumers still feel as good as they do now. And ultimately, because when you start to look at consumer sentiment indexes and measurements and things like that, they're really at very high levels. The happier the consumer feels, the more he's going to spend money, and consequently, that's good for the economy. So certainly there's always those unknowns that could possibly happen, and obviously they will, because that's just part of the nature of the year. But the reality is, though, that you're looking at a situation where you've got a lot on potential that could affect the markets, but certainly you've got some very strong things that we think are going to drive the markets in the economy. So when we get back, we're going to cut to the chase and finally get to our fearless forecast so we can start talking about the Secure Act as well here on the program. So stay tuned, dollars and cents. This is Joel Garris of Nelson Financial Planning here on News Radio WFLA Orlando. Well, we've teased it for the first half of the program. We're now going to get straight to the chase here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, and we are about ready to make our fearless forecast. To recap what we were talking about in the prior segment, we see the consumer very, very strong. That's the main driver of the economic engine. The consumer savings rates are up, not as overextended as they would typically be this late in the economic cycle. Rising wages, low unemployment, all very good stuff. Federal Reserve on hold with interest rates very, very low. The storm clouds exist because it's obviously a political season. That usually means heightened volatility. But ultimately that volatility goes away the closer you start to get to the election anyway. And of course, what ultimately will be the result of the pressure that's on corporate profit margins, especially with rising labor costs. Throw in there North Korea, China trade, Brexit, a host of other things. But it seems like a lot of those other things that we've been concerned about over the course of the past few years, Brexit, China, are starting to get somewhat resolved. Stay tuned, obviously, on that. But a lot of those conversations we've been having that have created concern and worry in the markets are, in fact, starting to show some level of a resolution. So, just as we saw 2019 as a recovery year from 2018, we see 2020 as more of a normal year, albeit an above normal year, because we do think that the consumer spending and low interest rates will be the big drivers out there in terms of the economy and the market. So with that in mind, normally the market 8% is the historical average. We think it's going to be run a little bit higher than that, and so consequently get more to the 10 or 11%. So here's the fearless forecast for the year 2020. We see the Dow Jones Industrial Average closing out the year 2020 at around 31,600. That's our forecast for the calendar year 2020. Mark it down. I know many of our listeners do. So mark it down and keep track of it. I know we will as well. And we'll see how all of this turns out 1 year from today. So 31,600 on the higher end, actually just outside the higher end of an average year. We think the year will be a little bit above average, so that's why we're calling for that close to 11% bump on the Dow Jones Industrial from where we are now, coming in at 31,600 for calendar year 2020. So we'll see how that all plays out, right? Stay tuned for a year from now, and we'll see how all of that lines up. So without further ado, let's shift gears, because there was a huge change while you were out buying Christmas presents and getting organized for the holidays. There was a huge change to your retirement. So we need to really dig into this as well. That's why we've sort of held the back half of the program for this. The reality is that when you look at this Secure Act, and you just got to love the politicians, right? The politicians, they come up with these unbelievable titles to describe these new pieces of legislation. It didn't used to be this crafty. Now it seems like every piece of legislation has a fabulous name and a fabulous acronym. So the Secure Act, which sounds really great, right? The Secure Act, secure, meanwhile, stands for Setting Every Community Up for Retirement Enhancement. Sounds pretty good, right? Unfortunately, I think the real title of this piece of legislation should be Setting Every Community Up for Trickery by the Insurance Industry. I'm not sure what that spells out, but I think ultimately this piece of legislation basically sets up every community for attack by the insurance industry. Why do I say that? Because the insurance lobby pushed this bill very, very hard. They pushed it very, very hard because one of the pieces of this bill is to introduce annuities much more pervasively into the 401k world, which is kind of fascinating when you stop and think about it. I mean, here we are, we've got the Secure Act where we're trying to protect retirement and set everybody up for retirement and all that, and you just introduced a product, or you just introduced a product to a much greater degree into that line of retirement assets, while at the same time there's been an ongoing trend in 401ks for lower and lower fees. A lot of it obviously good for employees, but one of the biggest things that spurred that reduction was that there was a multitude of class action suits against a lot of 401k platforms, challenging them on the underlying cost of their investments. Well, here's the crazy part. The typical 401k today has the lowest amount of cost down to like 30 basis points, 0.30. And now with the Secure Act, you've allowed for the introduction of a product that you've allowed for the introduction of a product that typically on the retail side runs anywhere from 2.2% to 3.8% in terms of the bells and whistles and the underlying expenses. So I find it fascinating that in the 401k world, where the costs have really gone down to benefit investors, to benefit employees, and now all of a sudden the folks in Congress are effectively reversing that by introducing a product that has the highest expense in the financial services industry. It's just another bewildering set of decisions and actions by the folks in Congress. Because here we want to help protect people's retirement. We want to enhance people's retirement. And at the end of the day, there's a massive shortfall in retirement dollars. It's projected that if you're between the age group between age 35 and 64, projected shortfall of retirement dollars over $3.8 trillion. 41% of households in that age group are projected to run out of money in retirement. And what did Congress do? They just allowed the insurance company into a much greater level of access into the 401k world. It's just bewildering. There's been an ongoing trend in retirement plans and retirement plan platforms that push the expenses down to the benefit of the investors, to the benefit of the employee. But now the folks in Congress roll out, hey, let's make annuities an option and that's somehow going to make retirement more secure. It doesn't make it more secure, it makes it more expensive. And ultimately, who pays the expense? It's the investor, it's the employee. It's just mind-boggling, especially against the backdrop where there's been countless class action suits against 401k platforms for being too expensive. Well, 401k platforms are some of the least expensive platforms in the financial services industry. Average expense of those platforms is typically on 30 to 35 basis points per year. You're dropping in a product that costs 2.25% to 3.8% per year? Doesn't make any sense. Some other things in this thing that don't make any sense at all. If that's not bad enough, the Secure Act kills one of the most tax efficient and most important estate planning option that was available. That wasn't really a trick because it was available as an option. It's an option. Poor choice of words on my part. The reality is that if there's a law out there that's got an ability for you to pass assets to the next generation tax efficiently and have that work in conjunction with your estate plan, then you need to be smart and make sure you follow through on that. Unfortunately, it's gone. It's gone. And that is to the detriment of many investors. We'll talk more about that when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio, WFLA Orlando. Of Nelson Financial Planning, talking a little bit on the program today about the Secure Act. The Secure Act, which is an acronym for setting every community up for retirement enhancement. God, you gotta love this stuff that Congress comes up with. What I really think the name should be is setting every community up to be exploited by the insurance industry. But hey, I don't pick the names. I just reviewed the legislation that's passed, and it's very clear the push by the insurance lobby to introduce annuities into the 401k world was pretty dramatic when you read some of the efforts that the insurance lobby did to get into the 401k marketplace. It's crazy that Congress fell for it because at the end of the day, annuities are perhaps some of the most expensive investment vehicles that you can own. So how is owning something that's more expensive going to somehow benefit me to help enhance my retirement? It makes no sense whatsoever. What also makes no sense is the elimination of perhaps the best tax efficient and estate planning option that investors had when it came to planning to pass retirement assets to the next generation. That concept was the Stretch IRA, which allowed you to name beneficiaries and have those beneficiaries then on a retirement account Those beneficiaries then had the rest of their life to take money out, leaving the rest of the account to continue to grow in a tax-deferred manner. What did the folks in Congress do with this legislation? And they eliminated it. They killed it. It's a massive change when it comes to estate planning and tax planning that folks need to really be rethinking exactly how they want those assets to pass and what's important to try and fund more rather than less. And here's the kicker. I pity folks that converted IRAs to Roths, because you paid taxes on it with the idea that your kids were going to inherit money tax-free that could grow on a tax-deferred basis for the rest of your kids' lifetime, and that's gone. Because the reality is that now they have to take that out over the course of a 10-year period of time. Whether it's a traditional retirement account or a Roth, you have to take that out now over a 10-year period of time. You cannot spread that out over the course of the lifetime. So this notion of I'm going to convert my IRA assets, pay the taxes now, and let the kids inherit a Roth, and that's going to be tax-free and grow tax-free as what, tax-deferred, and then when they take it out, it's tax-free. All of that gone, because they've now got to take it out over a 10-year period of time. That's a pretty significant change. Now, it only applies for deaths that occur after January 1 of 20. So if you inherited an IRA prior to January 1, then the old rules still apply. So that's good, because you still get to take advantage of that stretch concept over the course of the rest of your lifetime. For the 10-year period of time that you now have to take that money out, or you must take that money out, as with anything, there are, of course, exceptions, spouses being one of the biggest exceptions. Minor kids, but be careful there. Once those kids turn age of majority, then they've got to start to accelerate out the withdrawal on the account. So certainly big changes there in terms of how the IRA assets have to get taken out and paid out over the course of a much shorter period of time rather than one's lifetime. This is a massive tax generation item for the folks in Washington. They say it's not going to raise that much money. I think their estimates, as with any time the folks in Congress estimate anything, they're usually way, way off. I think they're way off on this one. I think this one's going to generate a lot more tax revenue over the course of the next 20 or 30 years than the folks in Congress realize, because the generation that is passing, that is leaving assets, is the first generation now that has retirement assets to leave. So the projections based upon current numbers do not reflect what is a massive amount of retirement assets that are about ready to pass to the next generation over the course of the next 20 years. It's going to generate a massive amount of taxes. That will be a benefit. Unfortunately, that doesn't benefit the investor, because that only benefits the folks in Washington, because now they've got more tax money. What they do with it, Lord only knows, but hey, that's a different conversation for a different show. Anyway, let's get to the silver linings of this thing. So there are some, so here they are. Silver lining number one, your required minimum distribution. Now you no longer have a required minimum distribution at age 70 and a half. It's now age 72. You must attain 70 and a half after January 1. If you've already attained 70 and a half prior to January 1 of 2020, then the old required minimum distribution rules apply that said if you turn 70 and a half, you got to start taking money out of the account. If you're turning 70 and a half after January 1 of 2020, then that means your required minimum distribution age will in fact be age 72. So at least you get to delay when you must start taking money out. Another big change is the elimination of the age restriction on being able to put money in. Look, if you're still working, no matter how old you are, 71, 75, 80, if you're still working and you've got earned income, you are now allowed to contribute money to a retirement account. So that's a big change for those folks that are working later on, and a lot of people are. And so consequently, you can still fund an IRA account or a Roth account as long as you've got earned income. There is no age restriction on that whatsoever. So that age limit is gone. You can now contribute regardless of how old you are. They did introduce an additional exemption from the 10% penalty, and that is that if you have a child or you adopt a child, then you're allowed to take out up to $5,000 from a retirement account and not have to pay a 10% penalty. It's kind of odd that they're trying to secure retirement or enhance retirement, and yet they're creating another exception to the 10% penalty to encourage people to use money from their retirement accounts at an earlier age than their retirement. It's just bizarre, right? Another way that this whole thing is just kind of bizarre is if we really want to enhance retirement, why are we then creating another exception to the early distribution rule that says, oh, you can get money out without having to worry about the penalty? I thought this was to enhance retirement, not encourage people to take it out right when they have a kid. Anyway, this is Congress. Here's the last item. If you have a 529 college savings account, you can take money out tax-free from that and repay up to $10,000 in student loans. That provision is retroactive to December 31 of 2018. So you can take money out of a 529. Let's say you've got a 529 college savings plan that was set up. Maybe you didn't, for whatever reason, not all the money got used out of it, or it just has been passed along. You can take up to $10,000 out of that and repay student loans. But that one's kind of weird too, because if you've got a college savings plan that's still got $10,000 in it, why did you take the loan in the first place, right? I mean, why didn't you just take the money out of there? But anyway, so now you can take $10,000 out of a 529 and use it to pay off a student loan if you have one. Again, that's kind of silly, but hey, that's Congress. So that gives you the overview of the Secure Act, which certainly has some pretty negative consequences of it, particularly from a tax and estate planning perspective. Some silver linings in terms of the higher required minimum distribution age at 72 and removal of the age restriction to make contributions to an IRA in the first place. All of that good, but at the end of the day, I think the elimination of the stretch IRA really is a tough element to plan for now that it has been eliminated. So good news, bad news, I guess, on that. I would say more bad news than anything. Anyway, we will wrap it up and get on out of here. Remember, next week we will recap the exactness of the numbers on the Fearless forecast and how the market closed out for the year 2019. So we will be back in the new year. Happy New Year to all of our listeners. This is Joel Garris of Nelson Financial Planning, Dollars and Cents here on News Radio WFLA.